Hey, what's up guys? Welcome back to the channel. Hope you all are doing good. So in today's video, we're going to cover the topic of margins. We'll understand what are the different types of margins, where do we use these different type of margins, and most importantly, what are the cases where we must look at margin expansion or contraction and where we must ignore them. And also we will look at how you can use margins as a confluence to add to your investment decision and for peer comparison of stocks within the same sector. So on that note, let's start the video. So let's understand what are margins. So margins are nothing but how much percentage of the sales company can convert into its profit. So let's take for example this company, Apollo Microsystem, and if you look at quarters, we look at company currently has margins of 31%. Means what? Company is able to convert 31% of its sales into its profit. And now it comes to the second part. What are different types of margins? So first we have is operating profit or operating profit margin, that is also known as EBITDA margin, which stands for earnings before interest, taxes, depreciation and amortization. So this is the first type of margin that we have, that is operating profit margin or EBITDA margin. Then we have profit before tax, that is profit before subtracting the tax. And lastly we have the net profit or the PAT margin. So let's briefly understand why we look at all of these three types of margins. So first is EBITDA margin. Why we look at EBITDA margin? So why we look at EBITDA margin is simple because it shows us how the core business or the core operations of the business are doing irrespective of other factors such as interest, taxes and depreciation. Because some companies that are capex heavy or capex intensive, they usually have higher depreciation costs in earlier part of the business, and that is why if you look at the net profit, that might seem a bit skewed. So that is why we look at EBITDA margin, because that tells us how the core business or the core operations of the business are doing, because EBITDA margin is basically sales minus direct and indirect expenses. So that is how we get the operating profit margin or the EBITDA margin, and why we look at that. Within margins as well, you don't want to see any abrupt changes. You don't want to see like 10% margins, then next quarter company is doing 15 to 50% margins, next company is doing 25% margins. You don't want that type of volatility. Yes, you need operating leverage. We'll discuss what operating leverage is, but you need a steady and gradual rise in margins. You don't want like these type of margins. You don't want a lot of volatility, and this is especially seen in steel companies or in metal companies, because in that cases the prices or the raw material prices or the prices of steel in the live market that fluctuates, and as a result the margin also fluctuates a lot. So in that case we can't look at it and be like, oh, company was doing 10% margin, now company is doing negative margin. We can't compare on that, because we also have to see raw material prices, how the prices of steel in the commodities market is doing, and all of that. So what we want to see, for generally excluding metals and commodities, what we want to see is a gradual uptick in the margins, and usually we want to see margin expansion, or the pace of EBITDA growth should be more than the sales growth. That shows that company is sitting on operating leverage. So this was the first type of margin, that is called as operating profit margin or EBITDA margin. Next we have this, the profit before tax margin. So that shows you how much profit the company is earning before paying off its taxes, and tax rate you don't have to pay attention. So you just have to see at how the company is doing before paying, after paying its interest, after paying its depreciation, amortization, how much profit the company has before paying off its taxes. And lastly we have the net profit, that is the net profit margin. So these were the three types of margin, and usually we want to look at EBITDA margins or operating profit margins, because I've already told you some businesses that are in the early stages of the business, like capex heavy businesses, they usually have higher depreciation cost, and as a result the net profit margin might seem distorted. Whereas if the company is actually doing well, its EBITDA margin will seem improving, but its net profit margin might seem a bit bad. So that is why we always look at EBITDA margin. And in some cases we look at profit before taxes as well, because some companies that are very asset light or do not have high debt in their balance sheet, they usually don't have a lot of other components as well. Now that we've understood what are EBITDA margins, let's understand where we should use EBITDA margins, right? Because margins is such a thing, you can only use margins for the same players within the same industry, right? So let's say for example a TCS, Infosys or Wipro, you only want to compare the margins of these three or these companies in the same sector, because these companies have similar business models, right? Now if you compare a steel company with let's say a FMCG company, or FMCG company with IT company, you won't be able to make the right decision, because these companies have different business models. Some business is very asset light, some business is very asset heavy. So these are the reasons why you should look at the margins of peers within the same sector. And if let's say one stock within the same sector has higher margins, then that company is superior, because that company has something that these players don't have. That is why it is able to have superior margins, right? So a classic example of where to use this EBITDA margin is peers within the same sector, and an example is Shilcha Technologies. So if you look at this company makes transformers, And if just pay attention to its EBITDA margins, company does close to around 30-35% EBITDA margins. And whereas its competitor, if you look at it, Tarrell, it does how much? 19-20% margins. So you can see there's a big difference between these two. Now, what are the reasons for its Shilcha Technologies? First of all, it is sitting on a high operating leverage. It has operational efficiency, and if you look at historically, this company has always had the highest margins. Now, I'll take a case where we cannot use margins for comparison. So let's take for example TCS. Right? If you look at it, TCS does close to how much? 27-26% margin. Whereas if you look at Tata Motors does close to 10% margin, 10-14% margin. So you can't use, so you can't compare Tata Motors with TCS, because Tata Motors is an automotive industry. Requires high capital investment, high capital expenditure, whereas TCS is comparatively asset light model. So that is why you can't use these for comparison. But if you compare TCS with Infosys, Infosys with Wipro and all of that, like if you compare Kalyan with Titan, then that is a good comparison, and that is how you can find out which company is better in terms of margins. So as I was saying earlier, what we want to see is we want to see a gradual uptick in the margins. As you can see, this company used to do around 8-10% margin. Now company is doing 19-20% margins. So you want to see a gradual uptick in the margin and not a lot of volatility in the margins. And even if there are certain industries where the nature of the business is such that the margins are volatile, but that doesn't mean the business is a bad business, right? That is just the nature of the business or how the business model works. So you need to understand that before investing in a company or understanding its margins. And what happens is usually in companies, when the raw material price is very volatile, these companies or the management usually hedges against these prices, so that even if there is an adverse movement, the company does not face any losses as such. Now let's understand a very important concept within this, that is called as operating leverage. So operating leverage basically means when the profit growth is more than the sales growth. That is because in some industries, there are two types of cost. First is a fixed cost, that is your rent that you have to pay irrespective of how much sales you are doing. Then it comes your employee salary that you have to pay irrespective of how your business is doing. And then there is variable cost that is directly linked to the sales. So if sales increases, variable cost also increases, like let's say power, electricity, fuel, that is called as the variable cost. So in companies where the fixed cost remains constant, so imagine fixed cost that can play both ways, good way and bad way. So if you have good sales growth, then you will have higher margins because your fixed cost is getting spread over more units. Whereas if you have low sales, means low sales growth, then you still have to pay the sales growth, right? Because the bank won't tell like, okay, you're doing low sales growth, you don't pay the EMI for now. No, the bank will pay me EMI irrespective of if your business is doing very good or if your business is doing very bad. So a classic example of operating leverage is a business by the name of Tata Elxsi, and it has a lot of operating leverage. We'll see why, because if you look at it, you can also see types of expenses. So if you look at it, employee cost is nearly 50-60% of its business. Why? Because Tata Elxsi is an engineering research and development company. So before the projects, they have to hire their employees, they have to train their employees, they have to make sure the employees work on different projects to gain some experience. So that is why you need to keep employees in check, right? So as you can see, this company had close to how much? 30-31% margins, and now company is doing 25% margins. Why? Because if you look at it, pace of sales growth, that company was growing at 35-40%. Even if you look here, company was growing at a good sales growth, and what has happened in recent quarters is company's sales growth has slowed down and company is doing negative sales growth. Also, this is the reason why earlier company, let's say company had 100 rupees of fixed cost, company was doing 200 crores in revenue, so company had 100% profit. If company has 300 crores in revenue, company only has to pay 100 rupees as fixed cost, and that 200 rupees will be its profit. On the other hand, if company is doing 50 rupees, say 50 rupees ka sales, then company will be in a loss of rupees 50 because company has to pay this 100 irrespective of how well the business is doing. So that is why we want to look at businesses that are sitting on operating leverage, right? For example, if we take this Manorama Industries that makes your fat butters and all that. So if you look at its quarter, so one way of finding operating leverage is if the pace of profit growth outpaces the pace of sales growth. So if let's say sales is growing at 20% and profit is growing at 30-35%, then we can see that there is operating leverage and there is a margin expansion. So let's take for example, as you can see in this quarter, company grew its sales by 117%, whereas if you look at its net profit grew by 274%, right? So pace of profit growth is more than the pace of sales growth. Similarly, if you look at it, company had done 80% sales growth, like 80% increase in sales, whereas profit grew by almost 240%. So that is another case of profit where profit growth outpaces your revenue sales growth, and that is why you see the stock has created a lot of money in the past. Almost like stock is almost doubled. So that is why you look at sales growth so that is why you look at margins and operating leverage from point of view of margins. So that is why you look at companies that are having high pace of sales growth as well as companies that are sitting on high operating leverage. And another interesting thing is that margin should always be looked in hindsight, because there are, like, let's take for example a company by the name of Alkyl Amines. Yeah. So if you look at this company, look at its historical margin. Company always used to make 19-18% margins. What happened in 2022 is company made almost 35% margins, right? Why? Because the raw material prices that crashed, and due to that, think of it, right? Company raw material price if crashes, then you'll have to pay lower cost and you will get higher margins. But what happens is you always need to pay attention for if there is any price erosion, if there is any dumping that is happening. Like for example, in case of Borosil Renewables, this makes your your solar glasses and all of that. So if you look at it, this company used to be the only player in India that used to make these glasses. But what happened? The government removed the ADD, that is anti-dumping duty, and due to which the company that was making 14% margins and almost 16% margins is now making single-digit margins. Because you see, solar glasses coming from China, Vietnam, all of these low-cost producers, they are selling the solar glass at very cheap rates, due to which Indian competitors cannot compete. So this, you also have to look at this from a point of view, and this is reflected in the sales growth as well. So you see, pace of sales growth has also reduced very much. So you have to pay importance to any special cases like these, or even in case of Alkyl Amines, where Alkyl Amines or Balaji Amines, where the raw material prices crashed, and due to this there was a demand supply imbalance, and these companies were making 35% margins. But the funny thing about margins is that margins usually tend to come back to normal. So if you see, company was making 18-19% margins, and now company is also making 19-20% margins. So you see that 35% margin, if you took that as a base and you would have seen 21% margin, you would have seen company is bad. But no, company wasn't bad. Company was just going through a phase of very high growth and a phase where other factors are favorable for the company. So these are the factors that you must always look at when deciding margins, or when looking at margins in the same industries. And not just Alkyl Amines, if you see like its competitors, Balaji Amines as well, even that was going through a similar phase in the 2021. Like, see, company was doing 19-20% margins, and company did like 29-27% margins, and now margins have returned back to normal. So always look at that. Like, whenever you're making investment, make sure that margins aren't at their peak, because if you were an investor in 2021 seeing that, oh, 20% margin, now company 30% margins without any, like, long-term specific reason, like, that these margins are not going to be sustainable going forward, because the prices are going to come back up, right? So you must see if the reason for margin expansion is sustainable. And you see, if you were an investor in 2021, you wouldn't have made a lot of money, right? Like 3000 say stock is down almost 50%. So always look at this whenever making investment. Make sure that margins aren't at the peak. There are some catalysts or growth drivers for margin expansion, company sitting on operating leverage, cost efficiency, debt reduction, all of these reasons that can make sure that you will actually make money and not get stuck in a specific stock. So that was it for today's video from my end, guys. I hope you guys liked the video, found it informative. And if you found it informative, make sure to like, comment and subscribe to the channel, and also share with your friends who are interested in investing and learning more about this stuff. And I'll see you in the next one. Thank you.